Today we tell you how Wall Street big brothers made huge profit from ambushing weak hands at last trading dates. We also told you how to spot evidence that they are taking action so as to follow suit. We also tell how traders can buy blue-chip stocks at deep discount price during flash crashes. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you. Crash is quick common in various markets. The causes of crashes include system errors, fat fingers, or when Wall Street big brothers squeeze longs and shorts. When crash occurs, they used to spread to other markets. The following is the chart of a simultaneous crash of all Europe markets during February 5, 2022. Quick flash crashes are crash that only last a couple of minutes, see 1-minute chart below. They often occur at times when significant economic figures are announced. They may also occur outside of normal trading hours when depth is thin. Those are the times for Wall Street big brothers to make profit by squeezing both long and short stop-loss orders. Trades may squeeze up to a plus or minus 5% discount to fair price order immediately after significant economic figures are announced. This is the normal range when figures announced are neutral. If the figure is not neutral, then this is a different story. Note that what they will do is to increase the bid-ask spread of the spot markets. The futures may not react to their action, and traders normally are not able to follow their actions. Ambush date. The big bosses will normally squeeze the shorts and longs at the last trading date that futures traded. This is reasonable as the current month game ends at last trading date and the contract next month is another game. When a bull or bear market is running, the big bosses will plan to obtain huge profit. They will buy large amount of options several days before the last future trading date. Sometimes, option premium price become unreasonably high, and this is time when we should be aware. The unreasonable become reasonable at the last trading date when future price crash and option holders lost their shirts. Those last trading dates are called ambush dates. More successful ambush examples. Black Monday, October 19, 1987, marked the largest one-day stock market decline in history. Are the most notable stock market crash dates that coincide with the last trading dates of index futures. Chart below is the U.S. oil futures on May 20, 2020, Monday morning. The U.S. oil May contract price plunged to negative $37.63 on its last trading date. Another successful ambush. On March 8, 2022, Wall Street big brothers squeezed the nickel contract's short seller and price surged to more than $100,000. Some holders of the contract were not able to meet the margin requirement. London Metal Exchange found itself in a crisis situation. As the guarantor of all contract holders, it was responsible for losing an significantly amount. They took action by suspending the trading and returning the price to the previous date, canceling billions of US dollars in transactions. Other than at times big brothers squeeze the weak hands, chance of buying deep discount equities occurs when there are system errors and fat finger events. Traders can place good till change orders at deep discount to try their luck. History shown that orders placed to smaller exchanges may have a better chance of not being cancelled after executed. See the stories followed. The fat finger mistake refers to a human error made by mistyping a trade. Next, we will first look at some historical incidents, then comment on how to take advantage on those incidents. In 2005, a fat finger error by a Mizuho securities dealer caused pandemonium on the Tokyo Stock Exchange when 610,000 shares in recruiting company JCOM were put up for sale at 1 yen each, instead of one share for 610,000 yen. The brokerage was forced to buy back the shares from market investors at a massive loss after the TSE dealing system failed to respond to an order to cancel the trade. The incident, among others, led to the resignation of TSE chief Takuo Tsurashima and an overhaul of the exchange's error-prone trading infrastructure. On February 25, 2009, Swiss bank UBS has confirmed that an internal system error was responsible for the entry of an erroneous 3 trillion yen trade. UBS said that its Japanese unit mistakenly ordered $30.9 billion of Capcom Company convertible bonds, 100,000 times more than it intended. The trade on the Tokyo Stock Exchange's T system was quickly spotted and cancelled at no cost to UBS, and trading in Capcom coupons suspended while the deal was reversed. On 2012, U.S. market maker Knight Capital Group almost went bankrupt after it lost more than $450 million when its computers made erroneous orders that couldn't be undone. The firm was later sold. On October 5, 2012, Fat Finger trade had triggered a huge flash crash, leading to loss of Rupee 10 trillion of investors' wealth at NSE. The so-called Fat Finger trade, which resulted in a trade getting executed in a fraction of a second for a whopping amount of Indian rupee 650 crore and triggering a massive flash crash, wiping off nearly rupee 10 lakh crore from investors' wealth in the Indian stock market within seconds. On October 1, 2014, Apen Securities Dealers Association, JSDA, confirmed the mistake that a member company made a fat finger error and traded 42 issues at the off-exchange transaction at 9:25. The so-called fat finger mistake was for an order worth more than the size of Sweden's economy. The biggest order was for 1.96 billion shares of Toyota Motors for 12.68 trillion yen. On May 2, 2022, a flash crash unsettled stock markets. It quickly became clear that the trigger was a mistakenly executed sell order by Citigroup. The order involved a basket valued at about $350 million for trades on the Eurostoxx 50, an index that tracks blue-chip companies in the Eurozone. The issue was further compounded by an error in a conversion to Swedish krona. Nasdaq and Euronext have said they are standing by the trades, so Citi needs to wear any losses from its mistake. On June 3, a data glitch led the global conglomerate's stock price to fall to $185 a share, having previously closed at over $620,000. The drop meant a more than 99% discount on the Warren Buffett-led company. On June 4, 2024 at 6:57 p.m. GMT+8, investors who purchased shares in Warren Buffett's Berkshire Hathaway yesterday at a huge discount will see their trades cancelled. We can learn from those incidents and avoid making their mistakes. We should also be aware that the possibility of order cancellation poses a significant threat to equity traders. Those who have placed both buy and sell orders might believe they have squared their positions and secured a large profit before the trading halt. However, if cancellations occur the following day, the orders intended to neutralize their holdings might be annulled. This could result in traders finding themselves unexpectedly holding net short or net long positions. Nobody will be responsible to their loss from those positions. Therefore, even after purchasing blue-chip stocks at steeply discounted prices, one should not rush to take profits. Acting prematurely could turn a dream of wealth into a bankruptcy nightmare. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you. Please note that our content is purely for storytelling purposes and should not be construed as investment advice, nor do we solicit investment funds.